Hi, thank you for checking out Keystone TV. The fact that you're watching this video today shows that you care about your financial well-being and your investment future. I want to share with you today a common question that I think all of us as investors face at some point and consider, and that is paying an advisor worth it? Should I be trying to do this on my own and save the money that I would have to, all the fees that I have to incur to work with a financial professional? And I want to give you a couple of different things to think about related to that. The first thing is, let's just digress a moment and talk a little bit about how is your advisor being paid, because that's an important step. You should be working with an advisor that is a fee-based advisor, not a commission advisor. There's a distinct difference. If an advisor is a fiduciary and a fee-based advisor, it means they are not receiving commissions or any payments from any third parties out there. Right? They're not getting bonuses from mutual fund companies. They're not getting commissions from fund companies. They're not getting various compensation bonuses from broker dealers and other things that would cloud their judgment. They're not being paid on a transactional basis, but rather the way that we're paid here at Keystone, and that I recommend, even if you don't work with us, that you should absolutely be working with someone who is paid and compensated in this manner, is it costs absolutely nothing to start with us. And if you ever want to leave, it costs you nothing. So we simply charge an ongoing advisory fee every single quarter that you choose to want to work with us, and you say, yeah, you're adding value for us. We believe you're worth your fee. And whether it's with us or someone else, that's the way you should be paying your advisor. Because now all your advisor is doing is saying, what is best for Mr. and Mrs. Smith? What is in their best interest? Because if I'm not being paid by any third party, only being paid advisory fees by my clients as long as they think I'm worth it, then all I want to do is provide them the best possible objective, independent advice that's out there to help them grow and protect their money and accomplish their goals so that they remain clients for a long period of time. They're happy, I'm happy, we're able to make money. So that's the first thing, right? Anytime we're talking about advisory fees, you should know very easily exactly what you're paying your advisor, right? There should be no question. You should be able to easily ask your advisor, what do you make and how are you paid? And they should very easily be able to show you a line item on your statement that says, this is exactly where I'm paid. Do you receive payment from anyone else? No. Or yes. And I'd be very careful if the answer is yes. It really should be compensated directly from clients on your behalf. So now that that's out of the way, assuming that they're being paid on a fee basis out of your account, let's look at the cost of working with an advisor, and the cost of potentially not working with one. I want to give you two different examples that recently came up. The first one is a gentleman who came in and he'd always done his investing on his own. And he had a little over $1 million. And one of the things that, he was like, it's really just a big leap for me to get over this idea of paying an advisor. So one of the things that we looked at and discussed when we were looking at his accounts is he had $250,000 that he had invested in an oil investment, in an oil well. One of his friends had recommended it. It was through some limited partnership of a friend down in Texas. Now, this was 10 years ago. He had seen not a single cent return from that investment. He said, I speak with my friend all the time, and he assures me that I'll be getting my money back. It's just a matter of time. During that same period of time, if he had just been prudently invested, he'd have around $500,000. That one decision that was speculative and emotional and not aligned with prudent investing will cost him $500,000. I mean, you can pay advisory fees for a long time to make $500,000. Second example, and this one's really sad, was a lady who had been doing it herself, and she didn't want to lose anything. So she had a teacher's pension and her Social Security, and then she was receiving she had a lump sum portfolio of about $150,000. And she had that in bank CDs making 0.1%. And as they were renewing, she didn't ladder them. So as they all renewed, she realized, this credit union over here is paying 0.4. So she, and some of these CDs were IRA. They were registered in her IRA. So she had an IRA and she invested them in CDs. Well, she didn't trust the bank and the credit union to get it transferred properly and all that. So she actually took checks from the bank and went and took them down to the credit union and put them in CDs over there. Well, the problem is tax time just came around, and she didn't realize and didn't notice when she made the change that actually the new credit union hadn't registered those CDs as IRAs, but rather just non-qualified after-tax accounts. So what in effect she had done was she had taken a distribution from her IRA in full. Not all of the money was IRA money, but a lot of it was. And she now owed $22,000 in taxes. So she had to liquidate another CD to pay the $22,000 that she owed in taxes. Furthermore, it increased her income, which also impacted her Social Security benefits. So now she had adverse implications on her Social Security. She had to pay $22,000 in taxes, all because she didn't enlist the help of a professional who could have helped her navigate that. And furthermore, could have explained to her why you wouldn't want to lose money to inflation on an ongoing basis and how to build a prudent portfolio that was conservative but also could keep up with inflation. So these are just a couple of the examples that I see regularly of folks trying to do it themselves. In many cases, they aren't even aware of the implications and the impact that their decisions are making on their portfolio. So I'm not suggesting you work with any advisor, and I'm absolutely not suggesting that you don't worry about the costs. You absolutely should understand exactly what you're paying your advisor, how they're being paid, what is your portfolio costing you, which we share with our clients, and we make sure you know that. If you don't know that, you want us to show you, we can absolutely do that for you. If you ask your advisor for that and they can't quickly provide that for you, there's a problem. Okay? But on a fee-based structure like ours, we always tell our clients, if we can't make you have an impact where we're able to provide for you better returns in addition to what you're paying us, then I wouldn't expect you to work with us any longer. But in terms of doing it yourself, the data shows that the average investor trying to do it themselves from an investment perspective loses about 7 to 8% of the long-term growth that would have been achieved had they captured market returns. That's a lot more expensive than any advisory fee I'm familiar with out there. If you like this video, you found it helpful, check out the rest of our videos at KeystoneWealthPartners.com, or you can like our Facebook page and get the content there at Keystone Law Firm and Wealth Partners. Thanks a lot for listening. Have a great day.